Hey friends, welcome back. Sean here. Hope you guys are having a good week. I wanted to do an update video. A year ago, I put out a video comparing different Canadian telecom companies, which has actually done quite well. There seems to still be a lot of interest in this, so I wanted to do an update. Things have changed in the field dramatically, actually, for a couple of these companies. So I wanted to just go through this again, provide some of the similar information. I beefed up my spreadsheet a little bit to hopefully give you guys a little bit more information, do a little bit more thorough of an analysis as well. And I mean, like I said, we all use probably one of these three or a company that is owned by one of these three telecoms if we live here in Canada. So you know what, we can't get away from these guys. They're in our pockets and we're paying them money. So we may as well look at whether they are worthy investments or not. I don't think that's just me. I don't think I'm the only person who thinks that way, right? We're smart people. So let's just dive into this and see what's under the hood of Bell, Rogers, and TELUS. So lucky for us, this is good timing. There have been some Q1 results for 2021 that have just come out for all three companies. So starting with Bell, did pretty well for this quarter. Their operating revenues are up from Q1 last year. Their EBITDA is up, and their EBITDA margin is about the same. Their earnings per share down by just 1 cent, and free cash flow up a ton. So from a first look here, Bell has done quite well for navigating, the illness last year. I know we're comparing numbers to maybe where their weakest quarter might have been in 2020, but all in all, telecom companies were actually relied upon very heavily. And while they did lose in some areas that we'll talk about in a bit, overall, yeah, all of them will look pretty healthy just like this. Now let's just remember with Bell, they also have like a media arm. They own TV channels and that kind of thing. So that's something unique that, let's say, TELUS won't have. And really their thing this year was continuing to expand their 5G and LTE network and basically keep everybody online and on their phones and on their internet, because if we were working probably from home. So we relied on these telecom companies a lot. Second, I'm just gonna pull up Rogers and their press release here. So again, a strong performance. They've executed improvements on their wireless, cable, and media. Rogers has a media section to their portfolio as well. You can see here they've had a lot of additions to postpaid subscribers, 44,000 to be exact. Another good thing is they've kept their churn down, which is how often customers kind of start and quit with their services. Services revenue down 6% and EBITDA down 1%. They were able to increase their cable service revenue, and they grew their media revenue by 7%. You can see EBITDA improved by 31%. So while there were some modest losses in some areas, pretty good gains in others. And then again, expanding their wireless service to more rural and underserved communities. And that's their way of expansion. Now, other than, expanding 5G, the biggest thing you probably already heard of was their acquisition of Shaw, which gives them probably a better foothold out here in the West, because Shaw was concentrated mostly in the West. Shaw also has, media services, and it just rolled out a mobile phone service. And so Rogers is familiar with all that stuff. It kind of made sense for them to look at this company to purchase it. But it's also one of those annoying things, I have to say it, about telecom companies here in Canada, is that they buy up any of the little guys that kind of start, that offer something new. And, there's a concern there about competition, I know, among consumers. So I have to say that, but that is a very notable thing that Rogers did this past year. Sorry guys, I had to get on my soapbox a little bit there, right? Okay, let's open up TELUS, and there's a summary on their documentation as well. They had a crazy amount of additions, 145,000 new net additions in devices and subscribers. Just the mobile phone additions were 31,000. They've kept their churn low, and they've added 63,000 just devices. So when I say devices, that could be like your Apple Watch or iPad going on to mobile service. They've had more additions of their pure fiber offering, which is like their high-speed internet. And here's actually the more interesting thing that I kind of want to talk about later, but this TELUS Health Services, and they are always a company, and that's what I like about TELUS, always a company looking to grow and expand, and they're expanding into the telehealth industry, which is, I find, rather interesting, especially because it kind of, the adoption got accelerated during, of course, the illness this last year, but also as the population ages and we start to get, I think, we'll start to get a lot more interest in the health sector. Telehealth is definitely an option or a way to apply technology that's going to help us cope with this when not everybody needs to drive to a hospital or drive to a clinic to get assessed. I think telehealth is going to be actually quite popular. So I really like this move from TELUS getting into this, and their revenue was up 10% in this young part of their company already. Finally, free cash flow was $750 million, and their quarterly dividend increased to $3.3162 per share, up 8.6% over the prior year. And we're going to talk about their dividend for sure a bit later. Okay, so that does it for the updates. Let's just jump into this table where I compare all three. I'll put it up on the screen right now. So you can see you got, Bell, Rogers, and TELUS across the top. I've averaged some of these stats on the side. This first section of the box is just as of the 29th of May, which is when I'm recording this video. I've got your ticker symbols there, the stock prices, market caps, so you can see like Bell is, substantially bigger than the other two companies, and the earnings per share there are also quite healthy. But Rogers probably wins there, and TELUS is a little bit lower. Now, if you're picking up these companies, you're probably worried or maybe looking for a good high-paying dividend. And the dividend here, I gotta give the edge for sure to Bell. So Bell, while it's got a larger company, maybe a more stable company, 5.83% yield at the time of this video versus 4.62 with TELUS, which is still pretty good, and then 3.21% for Rogers. So Bell definitely kind of shines in this category. Now, when I do the payout ratio to the free cash flow, it's a little bit high on Bell. It's definitely safer on Rogers, but definitely a concern on TELUS. And this is where I kind of want to stop here and talk a little bit about this. So when I look at a company, I typically look at the earnings per share and the dividend to see what the payout ratio might be. And you want to have something, like in the, well, every company has a goal, but maybe in the 60% range. Here we can see that earnings per share cannot cover the dividend that TELUS is, hoping to pay. Even the free cash flow by itself cannot cover it, and it's actually the combination of these two that are going to be the way that TELUS would hope to pay this dividend. This is not a situation you want a company to be in. It's not sustainable, and you can almost foresee that if things don't change, TELUS may have to reduce its dividend or put its increases on hold, at least to let itself catch up. That's just personally what I think, and I know I'm kind of predicting, but it's definitely something where if you're looking at TELUS strictly for dividend, you might want to brace yourself for in the future. TELUS even has in their financial statements, they're saying that the lower than planned free cash flow could constrain our ability to invest in operations, reduce leverage, or return capital to shareholders, and could affect our ability to sustain our dividend growth program through 2022. And that is a program where they kind of committed to increasing their dividends by a certain percentage for the next few years. Now, that's okay. Like I said, they should, if it's what's best for the company, tame this a little bit, or maybe just give an increase that's not quite as high as what they were hoping. But you got to make sure the company's still around later, and you're not just giving away all your money in dividends. So I can kind of see where they're coming from on this one. Let's jump back to the table now, moving down. Price to earnings ratio. This one definitely goes to Rogers. It's probably the healthiest there. Bell, again, still pretty good. The average for all three is 23. So either of those first two options, you can say your price to earnings ratio for the last year is best with one of those. I still wouldn't rule TELUS out for this reason. All three of these companies, when you compare their past P/E to their forward-looking P/E, forward-looking P/E is all lower than their past, so that's a good sign. You want to see that. Price to sales ratio for all three, quite healthy. Price to book for all three, pretty good. PEG ratio for all three, you want the lower the better here, so maybe you give it to Rogers and TELUS. Current ratio, again, pretty typical, nothing to worry about. Operating margins very similar, although a little bit thinner again on the TELUS side. Other metrics you kind of want to look at for telecom that are unique to this industry would be your subscriptions, and see how many users are they getting, like how many devices are they connecting. So this is what I put together just to give you a quick summary. Now, here are the subscriptions from just this last quarter. You can see how well TELUS did compared to the competitors. If you divide that by the total number of subscriptions, now I know the total includes these, but it's just to give you an idea. 0.9% growth for TELUS versus kind of the 0.3, 0.4% for the other two. Again, a great indicator. This shows, high growth potential, and for future earnings should go up. But you have to consider this with the financials as well. Churn rate pretty low for all of them, and ABPU stands for average billing per unit, and these are down across the board, which means that they're not billing their customers quite as much. But the excuse referenced for I think all three was the fact that people weren't traveling and weren't paying roaming charges that they normally would pay. So that's where they saw the biggest loss in billing. Last thing I'm also going to say is that there are some nuances where some of these companies offer certain services in certain provinces, but not in others. So you do have to consider there's some variability geographically that way, but this is as close of an apples to apples comparison that I could come up with. Okay, so what does this all mean? You're like, Sean, okay, great. You're throwing all these numbers at me. What is the best buy here? Well, I think it kind of depends what you're looking for. If you're looking for good dividend and stability, Bell is looking quite nice right now. I think it would be a good company to build a position in, especially if you're after a high yield and having some passive income through dividends, which I'm a big fan of. Gotta love dividends. But I do have to kind of go back and give TELUS some credit, because every time I make a video, it seems like they're getting into some new industry and trying to grow the business, and their revenues, when you compare them to the other companies, are up year over year, and that's how they're connecting so many subscribers, or they're offering all these new services. And I just don't see that type of growth in some of the other companies. So I definitely see kind of Bell on the more stable sort of blue chip side, TELUS on the kind of like higher growth, but still a pretty good dividend. And I'm like, fingers crossed that they'll keep it high and not like have to reduce it, at least just like keep it steady. And then Rogers is somewhere in the middle. I want to see where this Shaw acquisition takes them. Are they going to be doing security or something? I don't really know. But I'll tell you one thing, for kind of an older industry and something that's, where you don't have a ton of choices as a consumer, it's kind of exciting as an investor to see what these companies are going to do. Okay. So those, I think, are kind of my takeaways. Is you have a bit of a spectrum of choices here. It's an exciting time to sort of try to invest in these. I think there's some growth potential there, especially for TELUS. Now, I've got to be transparent with you guys. I own both of those suggestions. So I actually own Bell. I bought it pre-COVID, and then I picked up some TELUS in March of 2020, which of course came back and has done really well. But I am trying to build a little bit of a position in Canadian dividend stocks in order to try to get some passive income that I'll try to build up over time. So, I mean, these have done well for me so far. I hope you guys are considering something similar. I hope they do well for you as well. But I'm also kind of interested to see what Rogers does with this acquisition and where they will be in a year. So you'll bet that I am going to try and make a few more update videos. But that's all I have. I don't know how to sign off. How do I sign off? How do I sign off of this video? Please hit that like button. That would be great. It's a very small commitment, but it would mean a lot to me. But anyways, guys, I hope this was helpful for you. Have a great week. I'm gonna leave all the links to my sources in the description as usual. But yes, great week, guys. Spread the wealth. We'll see you in the next one. Bye.